Oil just spiked, and this time, it's not speculation. Iran has already shut down one of the world's most critical oil routes. That means the shock isn't coming, it's already here. And your cost of living could jump faster than you think. 1. Why oil prices react first to war. Let's start with the simplest idea. Oil is the world's most sensitive price. Unlike most products, oil reacts instantly to fear. Not actual shortages, but fear of shortages. When conflict breaks out, traders don't wait to see what happens. They start buying aggressively, expecting supply to drop. That surge in buying alone can push prices up dramatically. Think of it like panic buying, but on a global scale. Now that Iran is already at war, the market isn't waiting for confirmation. Prices are already moving, and they can spike within hours, not weeks. Why? Because oil isn't just another commodity. It's the backbone of the global economy. Every truck, plane, ship, and factory depends on it. 2. The Strait of Hormuz is already closed. Now this isn't a what if anymore. The Strait of Hormuz, the single most important oil choke point in the world, is already effectively closed by Iran. Iran has blocked or severely restricted ships tied to the US, Israel, and their allies, turning one of the busiest energy routes on Earth into a high-risk zone. At the same time, attacks, threats, and uncertainty have scared off shipping companies so badly that traffic through the strait has collapsed. What used to see over 100 ships a day has slowed to just a trickle. Some vessels are stranded, others are turning back. Even countries trying to negotiate safe passage are facing delays, confusion, and risk. This is what a real supply shock looks like. Oil isn't just at risk anymore, it's physically harder to move, and that changes everything. Because once a choke point like this is disrupted, the global system doesn't just bend, it starts to break. Buyers scramble, prices spike, markets panic. And here's the key idea. You don't need a total global shutdown to trigger a crisis. Just slowing the flow through one narrow passage is enough to send oil prices surging and your everyday costs right along with it. 3. A country in energy emergency. Now let's make this real. Look at the Philippines. After the disruption in the Strait of Hormuz, the government didn't treat it like a normal price spike. It declared a national energy emergency. Because this isn't just about expensive fuel. The Philippines imports almost all of its oil. So when global supply tightens, the impact shows up fast and there's very little buffer. Officials warn that the country only had weeks of fuel reserves, not months. That means every day without stable supply isn't just costly, it's risky. And the effects are already visible. Some gas stations have temporarily shut down due to limited supply. Airlines have started adjusting flights to conserve fuel. Transport groups are protesting because rising costs are making it harder to operate. This is what an energy emergency looks like. Not total collapse, but clear signs of strain across daily life. Fuel becomes less predictable, prices move quickly, and both businesses and households start adjusting in real time. Here's the key takeaway. When a country reaches this point, it's no longer reacting to a potential crisis. It's managing one. And for highly import-dependent countries like the Philippines, this is exactly how an oil shock begins. Quietly at first, then all at once. 4. What $200 oil actually means. Let's put a number on it. $200 per barrel. That's not a random figure. It's a level analysts often mention in worst-case scenarios. But what does that actually mean for everyday life? First, gasoline prices don't just rise, they surge. If oil doubles, fuel prices can jump fast, sometimes even faster due to panic and speculation. Second, transportation costs explode. Everything you buy, groceries, electronics, and clothes has to be shipped. Higher fuel costs mean higher delivery costs, which get passed directly to you. Third, Businesses raise prices to survive. Airlines increase ticket prices. Delivery services add fees. Manufacturers adjust prices across the board. So $200 oil doesn't just affect drivers, it touches nearly every dollar you spend. 5. Why prices jump faster than they fall. Here's something most people don't realize. Prices go up fast but come down slowly. When oil spikes, companies react immediately. They raise prices to protect their margins and avoid losses. But when oil drops again, prices don't fall as quickly. Why? Because businesses want to recover losses from the spike, and because consumers tend to accept higher prices once they've adjusted. This creates a ratchet effect. Prices move up quickly during a crisis, but only ease down gradually afterward. So even a short-term oil shock can leave long-term damage to your everyday expenses. 6. The hidden chain reaction. Oil doesn't just affect fuel, it triggers a chain reaction. It starts with farming. Modern agriculture relies heavily on fuel for tractors, irrigation systems, and transporting crops. Higher oil means higher food production costs. Then comes packaging. Plastic is made from petroleum. So when oil rises, packaging costs rise too. Then retail. Stores pay more for shipping and inventory, so they raise prices on shelves. This is how a war-related oil shock spreads quietly across the entire economy. You might not connect your grocery bill to oil prices, but they're deeply linked. 7. Why inflation can spike overnight. Inflation usually feels gradual, but oil shocks are different. They can create sudden inflation spikes. When fuel prices jump, transportation costs increase immediately. That feeds into food prices, delivery costs, and services within weeks or even days. Businesses don't wait. They adjust prices quickly to avoid losses. And because oil touches so many industries at once, inflation doesn't rise in one area. It spreads everywhere at the same time. That's what makes it feel like your wallet is being hit all at once. 8. Who gets hit the hardest? Not everyone feels oil shocks equally. Lower income households tend to get hit the hardest. Why? Because a larger portion of their spending goes toward essentials like fuel, food, and utilities. When those prices rise, there's less flexibility. Higher income households may cut back on luxury spending, but lower income households often have to cut essentials or rely on credit to get through. This creates a widening gap. The same oil shock affects everyone, but the impact is far from equal. 9. Why governments can't fix it quickly. You might think governments can step in and control prices, but oil shocks are global. Even if one country releases reserves or adjusts policies, it can't fully offset a worldwide supply disruption. Strategic reserves can help, but they're temporary, and they're often used carefully, because once they're depleted, there's no quick refill. Governments can also reduce taxes or offer subsidies, but that shifts the burden elsewhere, often increasing national debt. In other words, there's no instant fix. When oil spikes due to war, the economic pain usually has to run its course. 10. The psychology of panic buying. Here's where things get even more unpredictable. People react emotionally to rising prices. If gas prices jump quickly, drivers rush to fill up tanks. Some even stockpile fuel. This surge in demand can create temporary shortages, even if supply is still available. The same thing can happen with groceries and essential goods. This behavior amplifies the problem. It turns a supply concern into a real shortage, and that pushes prices even higher in the short term. 11. Markets move before reality hits. One of the most important things to understand is that markets move on expectations, not just reality. If traders believe oil supply will be disrupted, prices rise immediately, even if no physical disruption has happened yet. This means your costs can go up before the actual crisis fully unfolds. Gas prices may rise before any tanker is blocked. Airfare may increase before fuel costs actually spike. It's all driven by anticipation, and in a fast-moving geopolitical situation, anticipation can move faster than facts. 12. How central banks react to oil shocks. When oil prices surge, central banks face a serious dilemma. On one hand, rising oil pushes inflation higher. On the other hand, higher prices slow down the economy. Normally, central banks fight inflation by raising interest rates. But here's the problem. This kind of inflation isn't coming from strong demand. It's coming from a supply shock. Raising rates too aggressively can slow the economy even further. But doing nothing allows prices to spiral. So central banks often take a cautious approach, moving slower than usual, watching closely, and trying not to make things worse. For everyday people, this creates uncertainty. Borrowing costs may rise, but not in a predictable way. 13. Why loan payments can get more expensive. Let's talk about borrowing. When interest rates rise even slightly, loan payments increase. That affects mortgages, car loans, and credit cards. But during an oil shock, something else happens too. Banks become more cautious. They tighten lending standards because they expect more financial stress across the economy. So even if you qualify for a loan, you might face higher interest rates, stricter approval requirements, and lower credit limits. This makes it harder and more expensive to access money when people need it most. 14. The risk of job losses. Here's where the effects hit even harder. When costs surge, businesses have to adjust. Some pass costs to customers, others cut expenses. And one of the biggest expenses for any company is labor. Industries that depend heavily on fuel, like airlines, logistics, and manufacturing, often feel pressure first. If high oil prices stick around, companies may slow hiring, reduce hours, or lay off workers. It doesn't happen overnight. But over time, a sustained oil shock can weaken the job market, and that adds a second layer of financial stress, right when living costs are already rising. 15. What happens to stocks? During an oil spike, stock markets don't react evenly to rising oil. Some sectors suffer while others benefit. Companies that rely on fuel, like airlines and delivery services, often see profits shrink. Their costs rise faster than they can adjust prices. Meanwhile, energy companies may see profits increase as oil prices climb. But here's the bigger picture. When oil spikes sharply, markets tend to become volatile. Investors get nervous about inflation, slower growth, and global instability. That uncertainty can pull stock prices down across the board, even beyond energy-related sectors. So your investments may swing more than usual. And for many people, that adds another layer of anxiety. 16. Why small businesses feel it faster. Large corporations have buffers. They have cash reserves, pricing power, and global supply chains. Small businesses don't. When fuel and supply costs rise suddenly, small businesses feel it almost immediately. A local restaurant pays more for ingredients and deliveries. A small retailer pays more for inventory shipments. A service provider pays more just to operate day to day. But raising prices isn't always easy. Customers may already be stretched, so small businesses often face a tough choice. Raise prices and risk losing customers, or absorb costs and shrink profits. Either way, the pressure builds quickly. 17. The global ripple effect. Even if you're not in a major oil-producing country, you're still affected. Because oil is priced globally. When prices rise, it impacts nearly every country at the same time. For countries that import oil, the situation can be even worse. They have to spend more money just to secure the same amount of energy. That can weaken their currency, increase national expenses, and push domestic prices even higher. This creates a ripple effect. Global trade slows, Costs rise across borders, and economic stress spreads from one region to another. 18. Currency pressure and everyday prices. Here's something many people overlook. Oil shocks can affect currency values. When a country spends more on oil imports, demand for foreign currency increases. That can weaken the local currency. And when the currency weakens, imported goods become more expensive. So now you have a double effect. Higher global prices plus a weaker currency. That combination pushes everyday costs even higher. Electronics, food imports, and raw materials all become more expensive, and consumers feel it almost immediately. 19. Why recovery can take longer than expected. Let's say the conflict cools down. Oil prices start to fall. Does everything go back to normal quickly? Not exactly. Businesses don't immediately reverse price increases. Supply chains take time to stabilize, and confidence doesn't bounce back overnight. Some companies may have already reduced staff or scaled back operations. Rebuilding takes time. This is why the economic effects of an oil shock often last longer than the event itself. The initial spike is fast while the recovery is slow. 20. What you can actually do about it. So what can you do if oil prices surge? You can't control global markets, but you can control how you respond. Start with awareness. Watch your major spending categories like fuel, food, and utilities. Look for ways to reduce unnecessary trips or combine errands. Build a small financial cushion if possible. Even a modest one can help absorb sudden price increases. Be cautious with new debt during uncertain times. And focus on flexibility, keeping your monthly expenses as manageable as possible. These steps won't eliminate the impact, but they can reduce the pressure. 21. Why this scenario isn't impossible. A $200 oil scenario might sound extreme, but history shows that oil markets can move fast during geopolitical crises. All it takes is a major disruption or even the credible threat of one. And because today's economy is deeply interconnected, the effects spread faster than ever before. This isn't about predicting exactly what will happen. It's about understanding how quickly things can change and how those changes can reach your wallet. Here is the bottom line. This isn't just about oil. It's about how fast your entire cost of living can change. When a global choke point shuts down, the shock moves from markets to your wallet almost instantly. And by the time most people realize what's happening, they're already paying for it. Like to learn money the simple way? Hit like and subscribe.